Good morning, ladies and gentlemen, and thank you very much for joining us today for this third quarter Prescient Equity Update. I'm joined today by Bastian Teichgreeber, our Chief Investment Officer, and right next to me is Seeiso Matlanyane, who heads up our equity team. I'm Dawie Karstens, and I'm part of Prescient's retail business development team, and it's always a privilege for us to speak to our clients and our prospective clients. Bastian will start off with a macro overview of what has happened this year and our outlook going forward, and then Seeiso will take over and give us a deeper dive into our equity offerings. Just as a recap, all our Prescient equity funds use exactly the same process. Locally, they follow the various main indices, being the SWIX, CAP SWIX, Top 40 and ALSI, and from a global perspective, we've got the MSCI World and the MSCI EM Fund. So Bastian, 2022 turns out to be a exact case of the saying that goes, go away in May and but remember to come back in September. The market keeps going down and down. Can you shed some light for us?
Of course, Dawie, thanks for the question, although it's not a good question to start with. And thanks everybody for joining us once again. So I just want to start off by what has happened so far to equity markets. Obviously, we're massively down. I mean, we are going through a very, very steep hiking cycle driven by excessively high inflation, basically the highest inflation prints in 30 years. And on top of that, we have recessionary fears now. So there's more to come on top of that. We have heightened geopolitical tensions. We have a massive slowdown in China. We have a war in the Ukraine. So it kind of almost doesn't stop, Dawie. So I guess that's enough to start off with, right?
Thank you, Bastian. Okay, so Bastian, that's quite a few factors that you've mentioned. If you really have to choose one that stands out for you, what would that be?
Yeah, that's it. It's not so easy to measure that because obviously there's a lot of correlations between all the factors which have driven markets lower. But if I have to name one, it would definitely be the start of the Ukrainian war. And it's not about the war itself and the first order effects. We always highlighted that the Ukraine is a tiny portion of the global economy, also a tiny portion of global trade. The same applies to Russia. Having said that, the secondary order effects are really the problem here. So what worries us is that you can measure exactly the peak of the market in 2022 coinciding with the start of the war. And why that? Obviously because inflation started to once again pick up. We were on that flight path lower on inflation until the Ukrainian war hit, and then a lot of exogenous factors once again drove inflation higher. But I guess it's easiest if I just show that in 2 or 3 charts. Okay, so if we look into inflation and what happened this year, we have to really look under the hood a little bit. I mean, we know inflation was exceptionally high. We know inflation eventually peaked and came down, so that's a flight path so far. But what I really want to take you to is not the direct flight path of inflation, which you can see here, but more the composition of inflation and how the Ukrainian war really started to push inflation higher again. And for that, I actually want to start off with supply chain bottlenecks. You can see in the red area highlighted here, new and used motor vehicles. So that's basically supply chain disruption. That in itself doesn't really have too much to do with the Ukrainian war. But as you can see, the turnaround here happens exactly at the same point in time. Inflation drifts higher again, not driven by the Ukrainian war, but by the fact that China implemented its zero COVID strategy once again and that they tried to curb a new outbreak. But what we can see here is motor fuel, for example. This is driven by the oil price. The green bars, historically very volatile. But you can see that especially once the Ukrainian war starts, we see an uptick in the contribution of inflation, in the contribution of the oil price to inflation. Okay, all of that is now again on its way down, which is positive. But if we now add food prices as well, you can see food prices also started to really pick up during the Ukrainian crisis. So that's the reason why we have this negative market since the war started. It's not so much driven by the Ukraine or Russia themselves. It's more driven by the fact that we had higher levels of inflation, and with these higher levels of inflation, we had tighter monetary policy, and that needed to lead to a repricing of various asset classes.
Thanks, Bastian. And you are positive on SA equities. Are you not on the wrong side of that trade then?
Yeah, one could argue so. That's a good point, Avi. So over the short term, one must say yes. I mean, it obviously does hurt to be strongly positive SA equities in this market when we moved from kind of like 68,000 in the top 40 to now just 58,000. So we didn't really catch the peak here, we have to be honest for that. But we always want to highlight it's important to look at the bigger picture. So we entered into our overweight position basically later 2020. And since then, South African equities have actually really enjoyed a good rally. So long story short, over the short term, yes, it's hurting, but over the long term, the trade has actually played out reasonably well. And that's why the performance recently has obviously for our equity strategy, but also for our balanced fund drifted slightly lower. But on the bigger picture, we're looking quite good. I want to highlight also that for me, it's not always to just look back and explain performance. It's probably more important to look forward. And for that, I once again just want to show you 2 or 3 charts. Okay, if you look into our view for SA equities, we can see we are strongly positive, and that is driven mostly by the factor of valuation. So we really see valuations as quite attractive, but we see other factors also not as that negative. I mentioned financial conditions earlier. They've tightened quite a bit, but they're not tight yet. So all in all, we do still see a quite positive outlook on SA equities, as you can see also on this gauge on the right-hand side of the screen. If I look down a little bit before I drill into the individual factors, I want to highlight also the positioning of our models on SA equities. And you can see that we moved into an overweight position here already in 2020. So let's see what the market did since then. You can see that since 2020, which is roughly here, we have actually enjoyed a healthy rally. So no bad feelings here to be long SA equities. Always nice to time a peak, but it's not so easy, and we really try to get the bigger picture right. As I mentioned, for us, it's more about the outlook, and that's really what I want to focus on. So in this chart, we like to show on the x-axis the 1-year forward return of the South African market, and then on the y-axis, we like to show the density. So how often do we see certain observations of market returns? And we have colored in the different states of our model here in blue and red. So whenever the model is strongly negative, we would be enjoying this distribution. Obviously, it's not a great outcome. So you can see a lot of returns on the left-hand side of the other distributions, fat tails on the left-hand side, negative returns of up to minus 40%. So that's what we are in for if we invest in equities while we are strongly negative. But that's not where we are right now. Right now, our model still points to a strongly positive view. And as you can see in this dark blue distribution, we most often enjoy healthy positive returns. So these models are updating on a daily basis. These models evidently have a high degree of predictive power. And with that, we try to follow them. We know they're not right with a certainty of 100%, but we do know that the odds are heavily tilted in our favor once we follow this evidence-based approach.
So you say SA equities are cheap, but how do you actually measure this by?
Yeah, that's a good point. So obviously our process is heavily quantitative. So we always use the 4 factors: valuations, economics, financial conditions, and sentiment. And all of these scores are actually pointing us into the right direction, into the dark blue distribution, highlighting that the market is undervalued. This is heavily driven by the valuation factors, but let me show you these in detail. Okay, so just zooming out again, this is our view on SA equities, and you can see all our key factors which I just highlighted on the left-hand side: valuations, economics, financial conditions, and sentiment. And you can see the dark blue 0.8 out of a scale from -1 to +1 on valuation. So very positive view on SA equities, mostly driven by our valuation score. So what is the valuation score made up of? And for that, I would love to basically look into the individual factors. So let's see how, for example, our PE ratio looks. So on this chart, we put plotting the PE ratio, which is just one of the valuation factors we use. You can see that we have moved into really, really low territory. So statistically speaking, our PE ratio is now below a level of 10, which puts us actually in the bottom decile of return distribution, so of a PE ratio. Just, in other words, the market is just getting exceptionally cheap. We can use other valuation metrics as well, like our price-to-book ratio. So if I apply the same approach, now looking into the price-to-book ratio, you can see that we have cheapened quite a bit on the back of the price-to-book ratio as well. So whichever valuation metric I use, even if I look into price-to-sales, you can see that markets have turned out to become much, much cheaper than what they've been at the last 10, almost 20 years. So it's a strong valuation case which is mostly supporting our view to be strongly positive SA equities.
That makes sense, and I can understand that they are cheap, but what will help us from here? What will be the catalyst to help markets go up again?
Yeah, that's a good question, and I guess the answer is markets are cheap and you're having low PE ratios, you naturally have high expected levels of real return, and you have a very high dividend yield as well. So the answer in a nutshell is nothing. So we don't have to hope for a steep turnaround here to basically recover in equity markets. We are enjoying a healthy dividend yield and a healthy earnings yield. So not too much has to happen. We ask ourselves these questions because so much has gone wrong this year. But I guess the human biases to make us more cautious or more panicky than we should be is something which our systematic process is trying to overrule, so to say. And leading into our next questions, which Seeiso will cover, it's not only that we need nothing for equity markets to recover. Luckily, we also need actually nothing to happen for our alpha profile to recover.
Thanks, Bastian. You made a strong case for SA equities. Seeiso, if I can now move over to you. Can you confirm that our equity process is actually the right way to capture this upside that Bastian has described for us?
Yeah, thanks a lot, Davi. So I certainly believe so, because the way we go about in sort of capturing the equity returns is firstly by splitting the two sources of return. So when you invest in equities, there's inevitably the market return, which you'll get a healthy amount of, but then there is that additional bit over and above the market, which is often referred to as alpha. And our process, I believe, is best positioned to do this because we treat the two things quite separately. So we have a different source of market return to that of the alpha. Market return we simply get passively, which is clean, which is efficient, which comes at a fraction of the cost of managing money traditionally. And then the alpha component, we get that from a different asset class completely, being cash and money market. And that is also a much more reliable source of outperformance. Various studies have shown this. And therefore, by treating the two things separately, we definitely have a process that is best positioned for this type of for this type of market.
Okay, so we know that Prescient uses portable alpha strategy extensively within our equity range. If you can just maybe recap for us exactly how you split the alpha from the beta.
Okay, yeah, gladly. So we do use it extensively within our range. It is actually the main enhancer of our returns. It's the main way we add value to our market returns. And the way we do that is quite simplistically. We do not shy away from the use of derivatives. They are a lot more efficient than physical trading or cash equities, in the sense that it costs a fraction, literally a fraction of the cost to buy a derivative than it does to do so with a physical equity. And that, of course, that cost benefit is translated directly to our clients. With using derivatives not only is more efficient, but also takes away a lot of the operational risk with trying to manage 160 shares with corporate actions and cash flows. So we can simply capture the market return through one instrument, which is a much neater and a much cleaner way of getting market exposure. And the key thing with using derivatives is, of course, that they're mainly cashless transactions. So you're entering into a contract, and therefore very minimum cash is transferred between the two counterparties, which means that we can use the cash efficiently then to try and generate our performance or employ this portable alpha strategy. So to answer your question quite simplistically, it's the efficient use of derivatives plus cash and money market alpha, essentially.
Thanks, Seeiso. Given the very positive beta view that Bastian has described earlier, can you maybe share with us what the picture looks like from an alpha perspective?
Yes, I can certainly do so. So, and this is where it can become a bit tricky for equity people to start talking about fixed income assets. But the way we run these strategies is such that most of the alpha component comes from the fixed income side. So to give an outlook on what the alpha engine looks like, we have to start talking fixed income. And as Basti sort of mentioned earlier, it's been the steepest rate hiking cycle, and with our positioning in the very front end of the yield curve, we are of course susceptible to movements in the global macro and interest rate. Interest rate expectations. So to provide a view on the alpha engine, we inevitably have to talk about what the fixed income markets are looking like. And perhaps the best way to illustrate this is visually using this chart. So as mentioned, the best way to sort of think about an outlook for our alpha engine is to consider what's happening in the fixed income side of the world. And if you think about what we're really doing is we are funding at a short-term rate. And in this case, this is illustrated using the 3-month JIBOR. And we are investing in essentially a longer dated instrument, which in this case is illustrated as the 1-year NCD. And the difference between these two rates, where we are funding at and the yield that we're getting on the 1-year NCD where we are investing, is often referred to as the carry. And what this shows is that right there in the gray area, how this has been throughout time. Essentially, the wider this is, the more potential there is to generate additional performance in fixed income instruments and the portable alpha strategy. And what we can see is that this spread or this carry is at near time highs. And this just illustrates perfectly the outlook that we have for this strategy, because there is so much compensation for taking term risk by way of investing in 1-year instruments and borrowing at the 3-month rate. We have a situation where it has never been as attractive to run the alpha engine using this strategy.
Thanks, Seeiso. This looks quite promising, and you've painted a picture for us going forward. But we all know that rates have actually risen quite extensively this year. So what has that meant for the portable alpha strategy this year?
Yeah, great question. I mean, there's no easy way to say this. Rates have increased drastically, and a rising rate environment is not good for the strategy. And I always say, rates increasing is bad, but high rates that stay high or declining rates is good for the strategy. So the environment this year has been that of the most drastic rate hikes we've seen in the most recent history, and therefore the strategy has naturally struggled. But that's to a large extent because of our positioning, particularly when you consider fixed versus floating rate instruments. So we are positioned, again, bearing in mind of what we're trying to do here. We're trying to borrow in the short term, invest in the long term. We're positioned such that investing in the long term offers such a pickup over the short-term borrowing that it pays to go for fixed rate instruments over floating rate instruments. And perhaps this is better illustrated with this graph. All right, so if you look at the pricing at the very front end, what we're looking at here is the rate at which we essentially fund at, or 3-month JIBOR, versus the forward rate agreement curve. What the forward rates are simply what the market is pricing in over the next periods. So if we look at how this looked 2 years ago. You can see it was pretty flat, which means that there was absolutely no compensation for taking on term risk because the market was not expecting rates to go up. And as we look at how it has progressed from 2 years ago to 6 months ago, you can see it steepened quite a bit, and it has continued to keep steepening as we look at 3 months ago and then eventually today. So the gap essentially between our funding rate, which is that 3-month JIBAR, and what the market is pricing in is so steep. So we're earning 8.3% and we're funding at around 6.5%. That is essentially the gap that I referred to earlier as carry, and essentially the alpha that we port on top of our equity exposure.
Okay, so if I'm understanding you correctly, as rates were moving higher, you did not face the full mark-to-market movement of capital moving down, but you have locked in higher rates now, so you could potentially earn the full spread, or if rates compress, you can earn the full gain going down. Or if yields just stay where they are, you are going to earn a higher carry going forward.
Yeah, no, 100%. You've got that spot on. So because we're phasing into our positioning, obviously as rates were moving higher, we did not, it's not like we fixed a lower rate right at the beginning and we've therefore suffered all the way on the way up. We gradually built into our fixed rate positioning, which we saw is definitely the best decision to make. But the position we find ourselves in now is such that if rates just stay where they are, then we continue to earn that massive carry, or if rates come down, then we get a positive mark to market and we earn, we make back our performance quicker.
Okay, so can you in simplistic terms explain to us your base bull and bear case scenario, and what would be the most favorable conditions for alpha to come through in this strategy?
Yes. I can try and make it simple, but essentially what we need to see, we don't need to see much for the alpha to start coming through in the strategy. We essentially just need to see rate expectations to stop going up. You'll recall, as I said earlier, rising rates are bad, but if rates just stay where they are, given the yield that we have locked in versus the funding that we are paying, we essentially stand to earn that positive carry. That is our essentially base case scenario. Our bull case scenario is where rates come down, whereby we then, while still earning a positive carry, we now have this positive mark to market coming through as well. And of course, the bear case scenario will be an instance where rate expectations keep going up, but we know that there is a cap to that. So we have this sort of asymmetric payoff because rates will not keep going up forever and ever. At some point they need to come down. We have locked in rates that we found to be attractive, and we just simply need to sit and wait and let the process play itself out. And I think while we're on that point, it's important to talk about the scenario analysis that's been done for the path of interest rates, because there's ultimately the question of, if we are wrong, how wrong can we be before we start seeing a major detraction? And for that, I would like to pull up this chart and we can chat through it. Okay, so given those three scenarios, what we've essentially looked at is the bear case. So when rates keep going up. And we know that in our base case, in our bull cases, we make money. But how wrong do we have to be for us to start actually feeling pain from our bear scenarios? And what we're looking at here is the different types of instruments, just your call rate, a floating rate instrument, and a fixed rate instrument, 1-year instruments. And what we can see here is that even in the event where rates are going up, we still come out ahead with our fixed rate instruments over floating rate instruments up to and including 100 per pike. And it is worth highlighting that the path that is painted by this is such that we are assuming the most aggressive rate hikes. We're assuming that we see a 100 pip hike tomorrow, and even in that scenario where rates have gone up aggressively, our fixed rate positioning still comes out ahead over the subsequent 12-month period in terms of return.
That's interesting, Seeiso. So you've painted quite a few different outcomes here. Rates can go up quite a bit and we're not taking pain. Rates can come down and we're making money automatically. But what's the story if markets just pan out exactly the way that they are priced for? Do we still have room to create alpha then?
Yeah, that's a great question, and I think the beauty of the strategy is that we're working in the fixed income space, right? So we can do exactly that. We know how much is priced in, we know what rate we're getting, we know where we're funding. So it is a pretty simple exercise to do, to say, if everything just plays out as is, where does this strategy come out in terms of alpha? And I'm happy to take you through that. We can look at it visually and run you through just one of the portfolios. All right, so as mentioned, because we are essentially looking at fixed income instruments for our alpha profile, it's very easy for us to quantify where we will be given the rate that we are earning and the rate where we are funding at, and what is currently priced into the market. So I'm just going to build this up slowly. So what we're looking at here is essentially realized JIBAR up until the most recent period. And what that shows is the path that JIBAR has taken, and using the FRA curve which we looked at earlier, we can impose what is currently being priced in. And then we also know what our realized performance has been like, and as you can see, we have struggled a little bit, particularly when rate hikes or rate expectations increased in July, etc. And this is where we currently are. Now, assuming that we keep the same positioning, which we have, and we impose the hikes or the rate path that is implied by the market, we can very reliably come up with a path for our alpha over the next 12 months. So essentially, all our fixed rate instruments will earn the fixed rate. We're assuming that our funding costs will go up with the market expectations of rates, and we are assuming that our floating rate instruments will also likewise go up with the market expectation of rates. And what you can see here is that we are still expecting reliably a healthy amount of alpha over the next 12 months. And this is precisely the reason we prefer to use this as our alpha engine, because we know exactly where we're funding, we know exactly what rate we're going to earn when these instruments mature, we know what is priced in, and we can very reliably estimate the path to positive alpha over the next 12 months.
Thank you, Seeiso and Bastian. Bastian, you've painted the picture for us about inflation and expectations, and Seeiso, you about the alpha profile. Maybe just to recap again, what is the outlook going forward?
Yeah, that's a good point. Happy to sum it all up here, Davi. So we painted a picture on inflation having surprised on the upside like markedly over the last couple of months. We really see inflation peaking here. So not just about inflation, but it's also about interest rate expectations, which also need to be peaking right now. So what we're saying is inflation peaking, we've got interest rate hikes peaking. That creates a very positive outlook for equities in general. And then, as Seeiso alluded to, that if rates stop going up, we are perfectly positioned with our core equity strategies to leverage of not just the beta, but also the alpha and the funds.
Thanks, Bastian. And from your point of view, Seeiso?
Yeah, so what the outlook is, we just need to sit tight, because if rates stay where they are, the alpha process looks good. If rates come down from here, it looks even better. And even if rates continue to go up, as we saw, they would need to go up a hell of a lot more from where they are for us to actually start losing out on our view. So the outlook is simply, yes, it's been tough, but given the nature of these instruments, all we have to do now is just sit tight and let the performance come through.
Thank you, guys, and thank you for our attendees for attending today. If you haven't already asked your questions on the Q&A function, please do so now. Bastian, Seeiso, will you stick around to answer them?
Yes, no, definitely.
Of course.
Okay, so quite a few questions coming through, guys. Let's start with alpha. How much alpha can we expect over the next 12 months when you remove the funding costs, Seeiso?
Yeah, good one. Thanks, Davi. So that's exactly what that last chart was showing. And as you saw, it's sort of like well above 1%. So that final chart at the end there, which shows our realized alpha and then the projection of the alpha path over the next 12 months is sitting at just over 1%. And that is including funding costs. So that's taking off the funding costs and also including, what the market is currently pricing in. So, I mean, completely base case scenario, we're looking at around 1.2%.
Basti, if I can move over to you, you mentioned the steep hiking cycle. What is really priced in? How can you be so confident that we're at the peak and things will turn from here?
Thanks, Davi. Yeah, that's a good question. I mean, we have just maybe for me to start to say what is really priced in. So we are currently at 3 to 3.25% front-end rates. That's where the Federal Reserve has set the target range. And we are priced for another 7 hikes. So that takes the front end of the curve to 5% by March next year. So now you must just reflect on what we are talking about. We're talking about the risk-free, term-free interest rates at the very front end, and we are priced for 5%. So I'm trying to say, if you have any belief that the states will operate in a 2% inflation world at some point over the near-term future, and we priced for below that when you look at inflation swaps, well, then you can't run interest rates at 5%. So hence, just the reminder, interest rates and inflation have to be coupled, and they cannot continue to deviate for too long. We're seeing it painfully now with inflation coming down. Well, interest rates having to go up to catch up with inflation. But as inflation comes down, the story will turn quickly.
You talked quite a bit about SA equities today. What is the view on global equities?
I'll take that one. So yeah, we are still very positive on SA equities, so then nothing has changed there. Obviously, I mean, we made a strong valuation case just now in the webinar to highlight that the valuation case is very strong, and that's really overcompensating for all the risks which are in the market right now. I can't deny that there's tighter financial conditions, the economy is slightly weaker, sentiment is deteriorating. There's a lot of worries, so we get that. But at the same point in time, it eventually comes down to the price, right? And if I now turn globally, we have to separate clearly between emerging markets and developed markets. Emerging markets, we're starting to see a little bit of a mirror image to South Africa, because we also now start valuations to be priced to be much, much more expected. MSCI emerging market had a terrible year so far, which hurt us. But eventually it's in the price, and it's starting to look really, really be priced to kind of like a doomsday scenario, which makes it attractive. And if you look into the developed world, the story is different, because yes, we've also seen some repricing here, but markets do remain expensive at the current level. And if we now adjust earnings downwards, maybe a little bit on a slower global economy, well, markets will quickly start to look expensive again. So for EM equities, positive. For SA equities, positive. But for US equities or DM equities in general, not so positive.
Okay, so Seeiso, back to you. Obviously, hindsight is the perfect science. Just curious, given the outcome for Portable Alpha this year, is there anything you could or would have done differently given how the market has played out?
Yeah, so that is a slightly difficult one, but simple enough to answer. I mean, we're very systematic in what we do, right? So which means that all our decisions are informed by what is currently priced in, what the data is telling us. So thinking back to when rate expectations really started looking a bit overstretched, etc. So this was just before the Ukraine crisis. We would not have done anything differently because we are quite systematic, and at that time we saw the steepness of the front end. The price, the rate hikes that were priced in seemed implausible. So it was absolutely the correct decision to take, and it was one that it is one that we would take again. I think what hindsight shows us is that given how it's played out, we maybe moved too soon in that regard, given hindsight, but we would not go back and change anything in our decision making. This is exactly how we run these portfolios in a systematic way, in one that is transparent and with decisions that are quite clear and based on information, on the available information. And if I can just add on there quickly, I mean, given how things have played out, it is still it's never great to have struggled on alpha, but given the risk management and the sort of the tracking error constraints, we're still reasonably happy with the outcome, and we given the potential going forward, we're definitely in the best position.
Thanks. One more for you, Seeiso, and I think one more for you, Bastian, and then we'll wrap it up. Okay. Regarding the risk aspects of the performance and particularly the tracking error you have talked about in the various scenarios and the analysis that's been done, how do you ensure that the tracking error is managed and that the adverse markets don't move or moves don't blow you up?
Yeah. So the key thing to recall there is that the tracking error contribution is solely because of the alpha component, right? So it's tracking error, it's the standard deviation of alpha. So we manage our tracking error solely on the alpha engine. The beta engine is set to provide beta, which is 1-for-1 and pretty much zero tracking error. So to answer that question, we need to think about how do we manage risk on our fixed income component. And the main thing there, I mean, the biggest risk this year has been rising rates, and that has hurt us because of essentially duration, which is the portfolio sensitivity to interest rate movements. So we have very defined and very strict duration targets that we manage the alpha component to. And that's essentially how we keep the tracking error in check.
Thanks. One last one for you, Bastian. If DM equities are looking cheap, but if DM equities are not looking cheap, but EM are, is it possible for EM to move without improved sentiment towards the DM equities?
A question which we have to ask ourselves, because eventually for EM equities to move up, we actually need a little bit of a turnaround in sentiment here, because things are really priced for so much negativity. But the answer is actually not necessarily, because we think that markets are driven by 4 factors. We look into valuations, economics, financial conditions, and sentiment. So if one of them remains poor, let's say a sentiment, like relating to this question, sentiment remains very, very poor in emerging markets. First question I would ask, how poor can it be? Because it is really, really poor already. It can always get worse, but sentiment eventually is at the bottom. And then there's other factors. So far we've only been talking about a strong economic slowdown, about expensive valuations, tighter financial conditions. So those are the other 3 major factors. So the answer is yes, emerging markets can recover on poor sentiment, just driven by the fact that if we see a little bit of a different economic story, if we see a little bit of a turnaround in financial conditions, i.e. the Federal Reserve eventually backing off, potentially even pivoting, but we don't even have to go there, just stopping the hiking, and then valuations are cheap. And let's say none of this holds true, and we only sit on cheap valuations. Well, you've got like an earnings yield, which is eventually very, very high. So worst case, you just sit there and earn the dividends. Markets don't work like that. Eventually they will move, but very attractive valuations, eventually long-term will come through, irrespective of what the shorter-term factors like the sentiment do.
Cool. I think that's that for today. Thank you everyone for attending, and thank you, Seeiso and Bastian. We're going to post the poll just now. Please give your feedback on the webinar and it's been, our new format. And have a great week further.
All right. Thank you.
Thanks, guys.
Thank you everyone for joining us.